Hey Nolan, good to see you. Today we have a very important topic. We're talking about how geopolitical events affect the market. Specifically, we're talking about the tension with Russia. US equity markets are lower right now as investors try to determine what impact Russia's latest moves will have on the global economy. Investors are pulling money out of stocks and into traditional safe havens like gold and bonds. But as you and I have talked before, bonds have not been performing well this year. What are the other safe investments that you're advising clients to consider?
Sure. So, besides the traditional thought of investing into gold and bonds, like most folks do when times are tumultuous, some recommendations that we've been making also are keeping a slightly larger cash balance than you typically would in your portfolio. This does two things. Number one, it makes sure that, if the market does continue going down, you don't go down quite as quickly. And number two, if everything kind of remains as it is, you already know that you have cash aside to maybe make some purchases when buying points get a little bit better. So keeping a little bit more cash in your portfolio is something that we've been recommending a little bit, as well as maybe finding some investments that might have like stock exposure, but they're hedged through some sort of like options contracts or something to mitigate some losses. And what this does effectively is it exposes you to stocks, exposes you to the growth patterns, but it protects your downside. So if everything continues going down, you don't feel it quite so much.
hmm And now you have a team of investing experts behind you, including Brookstone CIO Mark Diorio. And he recently crunched all the numbers for other geopolitical events. Let's take a look. I know that you've studied this as well, right? But
Yep.
basically, when we look at this table, we see that the average one-day decline is negative 1.14%, with a total event-driven drawdown of negative 4.39% over 16 days, then recovering in an average of just 35 days. I think we live through these moments, Nolan, and we think that they're going to have a lasting impact, but statistically, that's not the case.
Yeah, and I think a lot of times it's a little dramatization of the
Mm,
event itself. It's just a little bit of either reaction or overreaction that causes some of these drawdowns. But I think the real story here is simply saying, I mean, those types of things impact you most if you invest where those events happen.
mm.
We run a relatively independent economy, even though we are, global as far as how our trade works. But if a bombing happens in another country and we stay relatively uninvolved, or even if we do get involved as a country, it doesn't usually impact U.S. stocks all that much unless it turns into a financial crisis. Think
Mhm.
about like 2008. So there's always overreaction. And I think it's just important to know that losses, especially losses when they're a little overreactionary, usually end up being temporary.
Yeah. It's just so hard not to, react emotionally. That's why we have you as the professional to kind of talk us through these moments. Because another thing that I'm always surprised to learn that if you miss out on just 10 days, if you pull your money out at the wrong time, you can like have your profits here.
Yeah. And there's two schools of thought really that go along with this. I mean, you stay fully invested and you encounter all the best days, but there's also really bad days in between there, and the bad days
Right.
are pretty bad. So staying fully invested a lot of times just does turn out to be the better option long term. Now, if that's a hard and fast rule forever, I'm not sure. But I do know that if you do decide to pull your money out of the market, or if you do decide to engage less with risky assets, you have to get it right twice. You have
Right.
to get out at the right time, and you have to get back in at the right time. And it's two really difficult things to do. If we could all do it, we'd all be sitting on a beach instead of, living in Michigan enjoying the weather. So, there are risks associated with trying to time the market. We like to use as many rule based metrics as we can when we're rebalancing our portfolios. But yeah, I mean, things change constantly. So you just have to remain adaptable.
Right. And I think that if anybody has concerns, right, Nolan, that's why you're there.
Yeah.
Call you, talk
Yeah.
this through.
Yeah, call us. You can visit the website and just find out a little bit more about what we do, or just call and say, hey, this is what I'm doing. Is
Yeah.
it right? Is it wrong? Is it going to work? Or am I taking too much risk or not enough? So,
Right.
yeah, we're happy to take a look and just let you know how you're doing.
Very helpful. All right, Nolan, thank you.
Thank you.